Hey guys, I'm here to go over chapter 5 with you very quickly. I have shortened the slides, so you should have taken notes on your own before you watch this video. So if you haven't taken your notes yet, stop the video, go take the notes. I have a Google slide that I've shortened that hits like the key main points. So if you missed those in some of the notes that you took, go back and make sure you put those in your notes. But we are going to create a note sheet, so make sure you have a blank sheet of paper. And we are going to do problem 5-5 partially together. We're not going to finish it out because I think that you guys will be just fine in grasping how to do this because we've been doing it. It's the same as chapter 4. We're just adding some different accounts. So I'm going to go ahead and pull up the Google slide here. And the first important piece here is that now we're looking at temporary versus permanent accounts. Temporary accounts start the accounting period with a zero balance. So if your accounting period starts January 1st, you go all the way through the year, December 31st, you will restart the year at zero. Basically, the point of a temporary account is to help accumulate amounts for one accounting period. So if we're looking at rent, for example, we want to know how much we paid in rent for the entire year, and then you start over so you can compare year to year. So what we'll do is at the end of the accounting period, we'll transfer the balance in these temporary accounts to the owner's capital account, and that's called closing, and we'll get to that in a later chapter, so don't worry about that quite yet. So a permanent account are accounts that show day-to-day account changes. They are continuous from one period to the next. So the best example for a permanent account would be cash in bank. Even though you end December 31st with $5,000 in cash in bank, you're still going to start the next year, January, with $5,000. It will continue to have the same amount in it versus that temporary account where we start over. So as we're looking at temporary accounts, we need to remember our rules for our owner's capital account. And just remember that on our debit side or credit side, this is how we increase capital, and that's the normal balance. So this is actually what I want you guys to record on your note sheet. So let me just close out of this or exit out of this. I want you to do chapter 5 notes, and you are going to basically recreate this on your note sheet. This is going to be the page that you need to refer to as we are going through our problem together. But basically, we have our permanent capital account as a big T. So if you want to write permanent capital, that's our big T. And actually in our chapter 4 notes, I had you put little stars next to like our revenue, expense, and withdrawals because those are going to be our temporary accounts. So we still have our debit credit side, our capital account increases with a credit and decreases with a debit. And as we're looking at our temporary accounts, we first of all have revenue. And we're going to put that on the credit side because revenue follows the same rules as our capital account. It increases with a credit. Versus our second temporary, any expense account, so expenses, they have the opposite rules because expenses decrease capital. So we can see that we would decrease with a debit. Let me get this thing to focus here. We decrease with a debit in our permanent capital account, so we're going to show our expenses as our holding account, and they will increase with a debit. And the same rule goes for our withdrawals. Increase with a debit, decrease with a credit. Okay, so you could have put these with your chapter 4 notes, But basically, this is what you guys need to refer to as we go through problem 5-5 together. All right, so I'm going to go back here. There's one more thing that I need to really hit on before we move on to problem 5-5, and that is our gap principle of revenue recognition. And that just means that anytime we earn revenue, we have to record that we earned it, even if we haven't actually been paid for it yet. So the example of revenue recognition here is business transaction 11. They billed City News for delivery services. So our revenue account is delivery revenue, and we can see that it is increasing by $1,450. And even though we haven't got paid for it yet, we still are showing that City News owes us that money. And we're just saying, hey, we earned the revenue, we haven't received the money yet, but we did make money at this point in time. Then when they pay us, we would decrease accounts receivable and increase cash in bank because they actually paid us at that point. So this is a generally accepted accounting principle, revenue recognition. Lastly, you guys are going to be asked to create a trial balance or to test for the equality of debits and credits. Basically, all you do is you list out your account names and you so cash in bank, for example, has a debit balance of $21,125. You would add up all of your debit balances, add up all of your credit balances, and make sure that they equal. So this is just a quick way to check for the equality of debits and credits because you should have debits equal credits at all times. So, alrighty, okay. We're going to go back here and we're going to look at problem 5-5. So 5-5 in our textbook, page 125. Lost my lid here, and that's okay. So page 125 in our textbook, it gives us our general ledger. It gives us all of our accounts that we're going to be using. And then it gives us instructions, and it says to prepare a T account for each account listed. So again, I like to go from left to right, and I'm just going to label cash and bank as our first account. And if you are still struggling with your rules here, this is a great time to practice or label how these accounts would increase or decrease. So cash and bank is an asset, and assets increase with a debit. Okay. So I'm going to go ahead and pause, and I'm going to go ahead and fill all these out. You do the same. Okay, so I got all my accounts labeled, and I decided to work through this part together with you guys. Abe Schultz withdrawals, and I even had a little mess up here, increases with a debit because withdrawals decreases capital, so it has the opposite rules. Then we've got boarding revenue. Revenue increases capital, so it's going to have the same rules. And so we've got two separate revenue accounts this time around, so really pay attention to which type of revenue they're using for each transaction. Then we've got advertising expense, equipment repair expense, maintenance expense, rent expense, and on the back we've got one little T account for utilities expense. And remember, expense accounts decrease capital, so they're going to follow the opposite rules of our capital account. So these will all be the same here. And utilities expense back here, debit, credit. Alrighty. Alright, so we've got step number 1 done. Number 2 says enter a balance of $15,000 in the cash and bank account. Also enter a balance of $15,000 in the capital account. So our normal balance is always on our increase side. So cash and bank, we're going to start off with a balance of $15,000. And our capital, we'll start off with a balance of $15,000. Guys, I apologize for this webcam. It's not wanting to focus for me here. Alrighty, so number 3, analyze and record each of the following business transactions using the appropriate T accounts and identify each transaction by number. So again, you guys can do by date or transaction number, it's up to you. Just watch out if we have like duplicate items on the same date, it might mess you up. So I'm going to use transaction numbers. So number 1 says we purchased grooming equipment for $12,700, check 283. Remember, anytime that we have ourselves using a check, that means that we are paying someone, so that's going to decrease cash in bank. So I'm going to do transaction number 1, $12,700, decreasing cash in bank. And then we purchased grooming equipment, so I'm going to assume grooming equipment is affected, and we are going to increase that. Now remember, we have a debit and a credit. You always have at least one of each, and that they equal. Okay, number 2, we wrote check 284 for advertising for $125. So remember, anytime we write a check, we are decreasing cash in bank. 125. So decreasing cash in bank. And we paid for advertising. So this is where these different accounts come into play, because before we were just putting them under our capital account. But when we're talking about keeping track of items for a business, we really need to separate them out as much as we can, so we know if at the end of the year we spent like $15,000 on advertising and we only brought in $20,000, a lot of our money went to advertising, and we need to make some adjustments there. So what's really important here about our advertising is remember, we always have a debit and a credit. So that should be your first indicator that we are going to debit advertising expense. But what I like to tell you guys as learners is that for the most part, unless you are doing a correcting entry or a closing entry, which we won't get to till later, we actually will not be using the credit side of our expense accounts. So for you guys to really get into the practice of, hey, I'm always going to debit my expense accounts, you can actually cross those out. If you don't want to do that, you don't have to, but just know that anytime you decrease advertising expense, you're saying I'm spending less money on it, and we want to know the total amount of money that we spent on each type of expense, so these will always increase. The same goes for revenue. We won't use that decrease side, and the same goes for withdrawals. We won't use that decrease side. So we're always going to be increasing our temporary accounts unless it's a correcting entry or a closing entry. Okay, so number 2, we decreased cash, but we showed that we spent money on advertising expense. Okay. All right, number 3, we received $1,850 cash for dog boarding services. So we received cash, and it's increasing. So 3 for $1,850. And we received money, so that's always going to go into a revenue account. And in this scenario, we have to determine which revenue account we're going to be using. And it says it's for boarding services, so I'm going to put that under boarding revenue. And again, we debited cash in bank, so we know that we need a credit to go along with that, and we know that we're always going to be crediting our revenue accounts. We're always going to be increasing those. All right, number 4, we paid $150 for equipment repair, check 285. So again, we wrote a check for $150, and we paid for equipment repair. So I'm going to move you guys, and we're going to do number 4 for equipment repair. Okay. All right, we're going to do one more, and then I'm going to let you guys finish out on your own. So number 5, we purchased a dog cage on account from Dogs and Cats Inc. for $75. And this is a transaction that we've been doing up to this point. So Cats and Dogs Inc. We purchased from them, so we owe them money, and we purchased a dog cage. So I would put that under grooming equipment. So our grooming equipment is increasing by $75, and we still owe Cats and Dogs $75, so that goes into that credit side, showing, hey, we owe them money. And again, if we pay them, we would decrease that account, showing we owe them less. Alrighty, so you guys need to finish out problem 5-5. I believe you guys can do that. Don't forget that number 5 says that you need to compute and record the balance for each account. So after you've gone through all the transactions, you need to calculate the balances in each account. Don't forget about utilities expense over here. And there, you might not even use a utilities expense. Okay. Problem 5-6, just for real quick reference, is where they're going to have you list out the account names and the debit credit balance. Just remember, you will only use one side. You will not do a cash and bank has a total debit and a total credit. It's one or the other. And I'll tell you right now, this first account will be cash and bank. And we know that cash and bank has a normal debit balance, so we're only going to use the debit side here. And then these two should equal when you add them up. Okay. Alrighty, again, feel free to email if you have questions or concerns, or if you're feeling like I am still completely lost. I promise we're going to have a lot more practice, but please communicate with me. Let me know what's going on. That's the only way that I can help you guys. Good luck, and I think that you guys will be fine. Have a good one. Bye.